They say that all roads lead to Rome, but I think it's probably more appropriate these days to say that all roads lead to China, both figuratively speaking as well as quite literally. I mention this because recently I attended, in California, a North American pension client event. 2 days speaking about how and where to invest across global asset classes. At the end of the event, they had what you call a bear pit. And this is where certain speakers were asked to come back on stage, and the delegates could ask or delve deeper into the key areas they felt were the most important. Well, those 2 areas: how to invest when it comes to the theme of innovation, and how to invest when it comes to China. Now, outside of China, most of the clients that we have will more often than not say to us, you know what, I understand the road that the Chinese are taking when it comes to economic growth. What I really struggle with, though, is what's actually happening on the ground there, and is this journey actually intact? Now, we do believe that when we build our portfolios, our underlying investment philosophy is stock selection. But in a place like China, you cannot ignore policy direction. Put really, really simply, think of this red policy line. It moves up and down. If you're a company that crosses it, that's not great for you. If you're too far away from it, you don't reap the benefits. So, when it comes to China, it's really your classic story about perception versus reality. And the reality is that policy matters. Now, the reality is also the biggest risk for China is policy mishap. Not just the Chinese government messing up domestically with implementing policy, but geopolitical tensions. Of note, and I was surprised that geopolitical tensions wasn't a key risk for you guys, but in terms of the relationship between the US and China. Now, essentially, when we look at the situation, it's pretty obvious what the US's stance is. The risk is how the Chinese are going to retaliate. So they too could increase tariffs, which is not going to be good in terms of pushing up input costs for the Chinese companies, who could then pass it on to the consumer, or it basically erodes or eats into their profits. So not a good outcome, and this is something we're seriously looking at all the time. But also at this juncture, if you were to say, you know, what are the percentage or the chances of a full-blown trade war? Maybe at the start of the year it was roughly 20%, now 10 to 12%, but certainly something investors should not shrug off. Expect for the foreseeable future this pattern of toing and froing with discussions. We certainly, by the way, haven't changed our portfolios as a result of these trade issues, because a lot of it is headline news flow, not a lot of details at this stage. Cast your minds back to those initial steel and aluminium tariffs that the US announced. Markets didn't like it at all, sentiment declined, but actually when you look at the true impact for the Chinese companies, as a percentage of total production, steel-wise, only 0.5% gets shipped to the US. Aluminium slightly higher at 1.5%. But as I mentioned, this risk is still there. And you've got to sort of take a step back and go, why is the US really targeting the Chinese? Why are they targeting those strategic sectors that previous presenters have alluded to? Well, there's an argument that they're worried. Their perception of the Chinese is that the Chinese are deliberately trying to increase their presence on both the economic as well as the political global stage. In reality, the Chinese are doing just this. In fact, by 2050, President Xi Jinping expects China to once again be the superpower. And being the superpower doesn't just equate to being the world's largest factory. He knows this. And this is why there are 2 strategies which are key for the Chinese. One Belt, One Road. I'm sure most of you have heard about it. Basically, the recreation of the Silk Road route, maritime railroad. It's now just dubbed Belt Road. Think of this as China's way of increasing their soft power status. They have a lot of capital, and they're funding projects not from China, just across into Europe, but here in the Pacific, Arctic, all the way over to Latin America. The US doesn't like this because it's today's equivalent of the Marshall Plan. From an investment perspective, it's quite hard to tap into this, by the way. To begin with, the projects are very long-term. You do also need to have both primary as well as secondary access. So a much more tangible theme to play, again, as investors, is the Made in China 2025 strategy. Again, it's not just a strategy that the Chinese people, the policymakers, the companies like to talk about. It's real. Evidence, as you can see here, in terms of R&D as a percentage of GDP, current versus 2005. Obviously, it's not as high as Australia, South Korea, but definitely making progress. Again, in reality, on the ground, for at least 18 months now, every company management team we meet talks to us about their innovation strategy. Not just unicorns, not just the tech companies, the healthcare companies, the consumer companies. Last year, we spoke to a metals casing company that was talking about how they're going to become more innovative. The Chinese don't want to be the copycats anymore. They want to be the innovators. Charlie mentioned Alibaba. They want more Jack Ma's, who founded the company. Now, how are they doing this, though? Again, management teams can tell us they're becoming innovative, but how are they doing it? It's the students of China, the last cheap resource. We've gone from 2 million to 7 million graduates a year. The majority of these students are engineers. The majority of these students, or graduates, earn less than what a factory worker earns. So they're smart, there's a whole lot of them, and they're very cheap. Or you could argue, well, India has a very similar sort of student demographic makeup, education's key for Indian culture, et cetera, Where China has the advantage is that they've been part of the supply chain for decades. Take Huawei. I'm sure you're all familiar with Huawei. Look at this. In 2010, their average pricing point for a phone, smartphone that is, $200 US, with about 1.8 million units sold. Fast forward to only 7 years later, a staggering 150 million devices sold, and all of a sudden the pricing point goes up to between 600 to 800, competing with the top-tier devices that are sold in China as well as globally. Now, with Huawei as an example, plus a new number of companies, it's not just the export market that the manufacturers are focusing on. They're tapping into the Chinese consumer. We've heard a lot about it already. Why wouldn't they? They understand the dynamics and the psyche of the Chinese consumer. In the 80s, even the 90s, when you think about it, are you a Woolworths person? Are you a Coles person? No such thing in China because there was no brand. So loyalty is key. The French companies, the luxury goods companies that we mentioned, they scratch their heads, these management teams, going, I don't understand how we're number one in 1 year, and all of a sudden we're surpassed by 3 other competitors the next year. So loyalty is sort of a new thing with the consumer base. This is why the likes of Alibaba, Tencent, they own the market. Now, another strong market player, and again, very hard to erode their market share, like Ali, is Kweichow Moutai. I don't know if anyone's had the sheer delight in tasting it. It is really perhaps one of the most disgusting drinks you will ever taste. Highly alcoholic. It's the equivalent of Chinese sake. The pricing point for a bottle, 200 Aussie dollars. Now, a bit like champagne, you can't call yourself Moutai, by the way, unless you're from the province of Moutai. And Kweichow just basically drives the province's GDP. So it's a unique brand. In 2012, 2013, the stock got heavily sold down because, if you recall, Xi Jinping implemented his anti-corruption campaign. And the perception was that Moutai was what all the policymakers would buy each other at the lavish dinners that they were having as presents to each other. What the market was missing, again, this premiumization story about the Chinese consumer, the growth of the middle class, is that your average Chinese person who was entering the middle class didn't want to drink a case of Qingdao beer. They wanted to start drinking Moutai. There is so much demand for this beverage. By the way, it's now the largest beverage company globally that they ran out of supply at Chinese New Year back in February. 90% of their sales, by the way, largest beverage company in the world, is Chinese. Although I was quite interested when I flew into Sydney Airport a couple of years ago, there was a big banner as you drive in or out of the airport with Moutai. I wasn't trying to encourage you guys to taste it or become accustomed to it. It was for, again, as we've been talking about, the Chinese tourists who arrived in Sydney to see, oh my goodness, Chinese brand in Sydney. It's becoming a global brand. It's even better than what